So you've got some money that you want to invest. You know property sounds like a good idea, but you're thinking stocks and shares, gold, silver, even cryptocurrencies. What should you do? And more importantly, how risky is property investment? Hi, I'm Simon, and over the last few years, I've used my money to build 2 property businesses, over 100 units. And on this video, I'm gonna break down exactly how risky it is and what the risks are and how you can navigate them. So if you've got some money and you're looking to invest, this is the video for you. Disclaimer, this is not financial advice. I'm not qualified. These are just my personal views and my experiences of somebody with 2 7-figure property businesses and over 100 units right now. So everybody thinks property, is a good idea, but you've kind of got these 2 schools of thought. You've got the one side that just think it is an absolute no-brainer. You can't go wrong, buy anything, add value and get rent until you're in Barbados sipping mojitos. And then you've got the other side that think, it's more hassle than it's worth. Tenants are a headache. What happens if there's a crash? All this sort of scaremongery stuff going on. And on this video, I just wanted to try and find a way to tell you my views and to communicate how risky it really is and how you can navigate it. The reason I'm making this video and the reason I think this topic is important is there's so much information out there that's just saying it's a no-brainer. And just a few years ago when I started, I felt like it could be risky, and I felt like this is the video that I would want to see so I could manage that risk. So on this video, I'm going to break down exactly what the risks are and how I'm moving past them. And I also just want to do another disclaimer and say I was not in property on the last crash, but this is based on research I've done into the market, speaking to a lot of people, having mentors and positioning myself based on what people learned from the last crash. So look, for me, property, the thing I like about it is a solid, tangible asset with an address. And guess what? Some of the buildings we're purchasing, they've been there for centuries, And they're gonna be here for the next centuries. They ain't going anywhere. They've got a fixed address. When you go to sleep tonight, you can rest assured that when you wake up tomorrow, God forbid, it's gonna be there, 99.99% of the time. Which means that your investment is secure, Particularly if you've got the freehold and you own the property, you are on the deed, that ain't going anywhere. That's the thing I like about it. The other thing I like about property is not only do you get the capital appreciation of the asset increasing in value, but you also get the passive income. It pays you every single month. And depending on the mortgage you've got, you may also be paying down the debt. So you've got 3 ways of earning money through property. The first way is it's going up in value. The second is you may be paying down the debt. The third thing is it pays you every month. And that is super powerful stuff. But there are risks. And today I want to break down 3 of the main risks that I think you need to be aware of. And I'm just going to break down exactly how I'm going about navigating them. Rule number 1, never, ever, ever invest in something that you don't understand or you don't know. And, I actually got into crypto a few years ago, on a pretty chilled, low level. But people come to me now and say, oh, you're getting into more crypto, you're doing more crypto. And quite frankly, I don't know enough. And I haven't got the headspace. I would rather I do property. I'm the property guy. If you want to talk about property, let's talk about property. Now, I might diversify into other asset classes, but they're going to be low levels of my portfolio and they're going to be passive, just buy and holds. So the first thing you want to make sure you do is invest in something that you know and understand. Warren Buffett says, he don't touch anything that he doesn't fully know and understand. Because when you invest in the unknown, things can happen. And some of the things that might happen in property is, you might invest in an area that you don't know or don't understand. I've spoken to people in the past that have invested abroad and, there's been certain government issues and they've ended up completely losing the asset, or, they've been away for a year or 2 years, they've come back and the whole place has been completely trashed just by local property people. So, investing in an area where you don't understand the legislation, the government, the housing acts is really, really risky. Really risky. You could lose all your money. You could go to zero. Another thing is, investing in properties reliant on something else happening. So let's say, for example, you buy a shop and you're looking to convert it into residential and you need planning permission to do that because it's got different access points and this, that, and the other. That's risky, because what happens if you complete on the property and then they don't give you planning? I was looking at a property down the road and it worked as, say, an 8-bed HMO and then you being able to build 4 houses on the bottom. But if we didn't get planning for the 4 houses and we just had the HMO, it wouldn't have been a good buy, and that could have put us in a pretty nasty place. So anything like that, you need to get really educated. And you don't necessarily need to know everything, but you need to have a power team of planners, of building regs, of people at the council, of fire safety people, HMO officers, whatever avenue you're going down, so that you can leverage against it. You can minimize the risk. So be really careful when you're buying stuff, hoping that you're going to get planning, or hoping that this is going to happen, or hoping that that is going to happen, because it just might not happen. And I've actually got a mate of mine that risked losing hundreds of thousands of pounds because he didn't get planning and he was waiting 2 years for the planning to eventually come through. Meanwhile, paying heavy bridging costs, so be careful for that. Another unknown is, I've seen people buy at auction without seeing the pack or without viewing the property in person. Really dangerous. You might end up buying a property with Japanese knotweed because you've just not done your due diligence. So the unknown is key. Is property risky? If you know your stuff and you're educated, no. If you don't, can be very, very, very risky. The second main risk in property is leverage. So all leverage is that if I buy a property for 100 grand, but I only have to put 25 grand down, I'm essentially leveraging my 25 grand to control 100 grand's worth of property. And not many investments will let you do that. That's why I love property, because you can own £100,000 worth of property for 25 grand. That's crazy. And the bank will lend on that. If I go into the bank and say, I want 100 grand's worth of Bitcoin, they ain't gonna lend me 75 grand if I put in 25. Whereas property, they will, because they know it's a secure asset class. But nonetheless, you don't want to over leverage. Now, there's a couple different ways of doing this. The first one is just buying a property for too much and maybe underestimating the refurb costs. So, you might say, I'm going to buy a house for 100 grand, spend 50 on it. But in the end, you end up spending 80 on it and you've over leveraged and you haven't got the money to finish the refurb. Okay? That's the first way of just over leveraging. You're pushing too much to try and do too much too soon. The second way of over leveraging is borrowing too much money against an asset. So let's say, for example, you're buying a house for 200 grand and, typically you'd put 25% down on that. But a few years ago, you could get a few specialist products where you'd only have to put 15% down. So let's say you buy the house for 200 grand, you only have to put 30 down, and for some reason the property price has dropped to 160, that would mean you was over leveraged and you'd be in negative equity. So what this means for us is you want to make sure, ideally, that you're buying at the right price and buying at a bit of a discount, or buying one of the worst houses on the best street so that you've got that cushion to add value. Little disclaimer here, if you're going to buy and hold, this isn't going to be that much of an issue, because you only lose money in investments when you exit, when you sell. And that's why, in my personal perspective, I'm not too fussed about, if the price drops, if there's a bit of a pullback after COVID, I don't mind, because I ain't selling, and you only lose when you sell. And finally, last but not least, the third point, and this is kind of linked, is interest rates. So at the moment, we're on really low interest rates, which means that your monthly payment, is a lot lower than it would have been some years ago. Now, it is absolutely inevitable that the interest rates will start to increase. And when they do, the debt is going to cost you more money per month than it did today. Now, what that means is you need to make sure that the cash flow, the rental income, has got a cushion and is high enough for you to be able to accommodate such increases in interest rates. And that basically means you want to make sure that your cash flow is decent, that this property is going to rent at a decent rental level. And the bank would have already done a stress test, by the way, to make sure that their investment in you is secure. But nonetheless, you want to make sure that if the loan, say, £200 a month and the cash flow is 600, you've got a decent cushion there, yeah? Decent cushion. If you're doing HMOs, your loan could be 500 and you could be bringing home £1,200–1,300. So then, you know, you've got a lot of cushion there. The second thing is you can start to find different products. So if you thought like there might be a bit of a hike in interest rates, you potentially could you could lock in an interest rate for 5 years. Meaning if you think, well, we're not going to get better interest rates than this, you could lock in for 5 years and you don't have to think about it. You don't have to worry about it. You know that your loan repayment is the same every single month for the next 5 years. And then you can just move forward. So look, is property risky? Personally, I think as long as you remember those 3 things, get educated and move slow. Don't try and leverage, do too much too soon. You know, don't go from like a 2-bed terrace to trying to do a 20-bed development and do the necessary steps. I think absolutely not. I personally like the idea of that's my building, I own it, it's going to be here tomorrow. I ain't going to wake up knowing that it's dropped by 50 grand. It's not a volatile market like that. And as I've said, if you're buying and holding for the long term, property increases, it doubles every 10 years. So I think personally, it's a safe bet. That's where I'm putting my money in.